Good afternoon, Rotarians and guests. Hope everybody had a fantastic Super Bowl weekend. Welcome to the Rotary Club of Toledo's virtual meeting featuring Loretta Mester, President of the Federal Reserve Board of Cleveland. But before we get started, I'll invite Father O to deliver a reflection and Matt Atkins to lead us as we stand for the Pledge of Allegiance.
Today we welcome to Rotary the President and Chief Executive Officer of the Federal Reserve Bank of Cleveland. And so we pray. You created us, Lord, to be gregarious, social, communal beings. We are meant to live with one another. And so we have commerce and trade with one another. Money is the tool we use for that commerce and trade. Help us to be mindful, Lord, that money and other material things are for our use. People are not for our use. And so we should never use people for monetary gain. Rather, we should use money to build better relationships with one another. We shall always be in the right if we use money to be fair to all concerned, build goodwill and better friendships, and be beneficial to all concerned. May you always help us, Lord, to do that. And to our prayer we say, Amen.
Amen.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Thank you, Father O, and thank you, Matt. I also want to thank Walker Funeral Home as February's weekly meeting sponsor. Thank you, Rotarian Derek Leck. I've got just a couple updates today. Just want to remind everybody about our survey. Please remember to take the vaccine survey that was sent out last Wednesday. The survey was also in last week's Spoke, and it's in today's meeting reminder. The deadline to take the survey is February 11th. Again, it's very important that you take this survey. Thank you. Also, a meeting's been set on Monday, February 22nd, following our Monday meeting with all committee chairs and co-chairs to include our club's marketing leadership. Please make a valiant effort to join us. You'll be glad you did. And finally, remember to send us your selfie when you get the vaccine. No more business to conduct, then I'll introduce Bob Savage, Rotarian Bob Savage, to introduce our speaker.
As was mentioned already, we are certainly glad to have Dr. Loretta Mester with us here today. And Dr. Mester, I don't know if Chuck will have any jokes about federal monetary policy, but you are in rare company actually being mentioned in the prayer. That doesn't happen often to our guest today. Let me take my glasses off so I can read this here. As Father O or President Ron noted, Dr. Mester is the President and CEO of the Federal Reserve Bank of Cleveland. She participates in the formulation of monetary policy and oversees over 1,000 employees in the Cleveland, Cincinnati, and Pittsburgh offices who conduct economic research, supervise banking institutions, and provide payment services to commercial banks and U.S. government. And she assumed this role in 2014. For a couple connections, actually, for our club to the Cleveland Fed or to the National Fed, Rotarian Keith Burwell is a member of the Community Advisory Council, a regional which advises the Cleveland office on regional community development issues, and our own Kendra Smith, who as Vice President Mercy Health here locally. Kendra has actually recently been appointed to a 15-person national committee and the Community Advisory Council in December, which works with the Fed across the country on regional and neighborhood development issues. Dr. Mester was born in Baltimore, graduated from their bachelor's degree from Barnard at Columbia University, then went on to earn her master's and doctorate in Princeton University, and was a National Science Foundation Fellow there. She is an adjunct professor of finance at the Wharton School at the University of Pennsylvania, graduate and undergraduate level. I had to mention my alma mater there. She also teaches at NYU. I'll abbreviate most of the rest of the intro, but she is also, outside of finance issues, director of the Greater Cleveland Partnership, the trustee of the Cleveland Clinic, trustee of the Musical Arts Association, the Cleveland Orchestra, and a member, this is the last one I'll read because if I read the rest of the list, we'd be on here for quite a while, but a member of the advisory board for the Financial Intermediation Network of European Studies. And certainly we all virtually give a warm Rotary welcome to Dr. Loretta Mester.
Thanks, Bob. I really appreciate the intro.
No problem. Glad to do it, and glad to have you here.
Great to be here.
Not only did you make it into the prayer, but we've attracted even more media attention than we usually do to a Rotary meeting. But I think you get part of it. We get some media, but we've got more today than usual, including a couple international outlets, as I believe you know, and then Toledo's finance business writer John Chavez from the Blade is joining us as well. So, I know this is sort of designed as a virtual fireside chat. Is there anything you wanted to say before we went into questions?
No, I'm just really grateful to be here. And I do want to thank our advisory council meetings. And a lot of you, I'm sure, are providing us with beige book information about what's going on in your businesses and what's going on in the Toledo area and economy. And, one thing that is very true, and it's even more true over the last year, is that in anecdotal, what we call anecdotal information, which is separate from like the statistics, but that really on the ground, what you're seeing, what you're hearing from your customers, how you're dealing with the pandemic was really vital and continues to be very vital for how we evaluate how things are going in our economies and in our regions. And I really just want to extend an appreciation to all of you for providing us that information. And I'm looking forward to the conversation because I always learn a lot by going on and talking to people like yourselves who are actually having to deal with a lot of the issues that arose with the pandemic and even before the pandemic and the economy. So just, I would just want to send you appreciation for engaging with me.
Well, on behalf of the club, we're glad to do that. And as I know, we solicited questions ahead of time from our club, and a number of you contributed. Thank you. So we are going to leave time at the end from additional questions from the virtual floor. And you can feel free to chat things in, and hopefully Kevin and I will keep an eye on that. And Dr. Mester, as I think you've seen some of these questions at least. Our questions will range from national and global economy down to more regional issues. But why don't we start with, no surprise, one of the bigger issues, one of the biggest issues in the economy and in the country, although certainly not the only one. We've been on quite a ride in the last 12 months. Take us through the Fed's key action over the past year of the pandemic.
Right. So both the federal government and the Fed really acted much quicker, much bolder, much bigger than in past events because this was such an unprecedented shock to the economy. And if you remember back a year ago in February, as the financial markets and businesses sort of began to understand the gravity of the situation. There was a lot of stress in financial markets. So, the first actions that the Fed took really were to try to address those stresses in the financial markets, because no one really wanted to see a financial crisis on top of a pandemic crisis. And so some of those actions included going in and purchasing large quantities of treasury securities and mortgage-backed securities, really to add a lot of liquidity to the market so that credit could continue to flow, because you don't want credit to stop, because then all activity in the economy stops. We also set up some what they're called 13-3 facilities. They're emergency facilities. They're only allowed to be set up in emergency conditions. And those are also to serve as backstops to try to address some of the stresses seen across various kind of markets, like the commercial paper market, the corporate debt markets. And then part of that also was setting up a Main Street lending facility, which was really intended to get financing to Main Street, to corporations, small businesses, and so that they could have liquidity again to sort of stay working, stay viable. Then, of course, we lower the interest rate, and that is a broad-based way of adding liquidity to the financial system and making financial conditions accommodative, again, to support the economy. And we brought down our interest rate to 0 to 1/4% in March, and it's been there ever since. Now, a lot of the activity that we were trying to do in terms of getting credit to businesses, small businesses and households, had to run through the banking system. So another thing we did is we wanted to make sure that banks had the capacity to continue lending. So we relaxed some of the supervisory and regulatory restrictions on banks, again, making sure that they could continue to lend to their customers and to others who needed the liquidity. Those actions were by the Fed, and then also the federal government, as you know, took some pretty bold actions. They, extended unemployment benefits. They set up a paycheck protection program, lending program, which those loans became grants if firms kept people on their payroll, which most of the firms that we've talked to said was a very big help to them. And then they also had these economic stimulus payments or impact statements. I don't like to call any of this stimulus. It's really relief payments so that, households and firms could get from the pandemic across to when the economy could begin to reopen again and to recover. So there were a bunch of actions taken. I don't like to call them coordinated actions, but they were very complementary actions from both the federal government and the Fed to try to get the economy so that it could make it through this really unprecedented event that we're still living through.
Sure, certainly. So you went through a number of things that have happened in the past 12 months. Where do we sit now, and where do you expect us to progress in the next couple of quarters?
Yeah, so it's interesting. I like to think of this in phases. There was the shutdown phase when, because of the stresses on the hospital system, activity shut down. Then there was a reopening phase when the caseloads got to be manageable, more manageable, we could open the economy up and back again. Now I consider us in this pre-vaccination mode. We're recovering, we've made some steps back from that really dim second quarter that we saw last year. And now, we're in this, we're recovering, but it's a slow recovery. Once everyone gets vaccinated, right, and whenever that can be, right, then I think we're going to see a strong increase in activity because people will feel they can engage again in activity. It won't be like putting on a switch. It won't be that some of those parts of the economy that need, person-to-person contact will come back immediately. But once everyone's vaccinated, I think we'll see things much stronger than they are right now. So we have to get to that point. So I like to say, the news on the vaccinations, the progress we've seen, that's the light at the end of the tunnel. But we don't want to be blinded by that light. We need to really understand that we have to get to that point. And that's what we're going through now. We're going through the point where there is recovery. Some sectors of the economy are doing much better than others. but we really need to get to the point where we have everyone vaccinated so that we can really get back to some semblance of normal and get back to that post-vaccination part of the recovery where people can get back to work in sectors that now are really not doing as well as others. And, as you know, it's been a very disparate impact in terms of where in the economy and the types of communities that have really been hard hit versus other parts of the economy that are doing pretty well.
Right. And along those lines, what's the Fed's current approach, and what are the key things it's looking during the current weakness in the economy?
Yeah, so what we can do with monetary policy is really ease financial conditions, which again is support, right, for the economy as it recovers. So we've done that, and Congress has given us what we call a dual mandate of price stability and maximum employment, and we are going to use all the tools at our disposal, right, to get back to maximum employment and price stability. So what we've said, of course, is that, we're not going to be moving interest rates up until we see inflation move back to 2% and on its way a little bit for moderately above 2% for some time. And we're going to continue to purchase these assets, long-term assets, treasury bills, mortgage-backed securities, until we've made significant progress along our way back to our goals. So, we're going to be in there using our tools to support the economy and using progress on our dual mandate goals as our guide to when to sort of back off from accommodation. But that's not going to be soon at all. I think that we're going to be accommodated for a very long time because the economy just needs it to get back on its feet.
And how long a period of time do you think what does this sort of look like?
Yeah, so I mean, that's what everyone wants to know, timing. I'd like to speak in terms of our goals, in terms of, we need to see significant progress to get back to those goals. And if you look at the Fed forecast that we put out in December, you'll see that it's going to be quite a while that we're going to have interest rates at the levels they are, just because it's going to take quite a while for the economy to get back to maximum employment and price stability. So it's going to take a while. I do think that once we see people vaccinated, majority, a large, basically everyone vaccinated in the country, then you're going to be able to see a stronger economy and a stronger recovery. But even in that post-vaccination stage, I think it's going to take some time because people have, it takes time for people to skill up again if they have to get a job in a different firm or even a different industry. Certain companies have gone out of business. It'll take time for new companies to come in and set themselves up. So I think, we'll be in what is a regular kind of recovery. But that's going to take some time as well. It's not going to be like all of a sudden everyone's vaccinated and then the world goes back to what it was before. It's just going to take some time.
Right. Sure. Thank you. So, Dr. Mester, you spent actually more of your Fed career in the Philadelphia office, and were working your way up. Although you have now called Ohio your home for the better part of a decade. Turning a little bit more to the region, you sit on the governor's economic advisory board. How are things looking in Ohio?
Right. So Ohio, really, the path in Ohio was the path of the pandemic in lots of places in the country. We were hit hard by the pandemic. Activity shut down. I think the governor and his government did a good job of sort of really taking it seriously from the beginning in terms of making sure that people remain safe, that there was masking, that there was social distancing, that there wasn't a lot of large groups. And, once it got safe, then firms were able to reopen, and there's some, protocols in place to make sure that people stay safe in their businesses. But the sectors that really were hard hit were the ones that are hard hit everywhere: restaurants, travel, those kind of sectors where you really need to have person-to-person contact. So those service sector kinds of jobs were really devastated by this. And small businesses were hit disproportionately hard because a lot of them cater to that kind of business. In Toledo, your auto industry, had to shut down the plants, but now they're reopening and they're doing well because autos was one of the areas that actually had strong demand. People were shifting from public transportation to autos. That was a good thing for the auto industry. The housing market is doing very well. And I know in Toledo, you've seen a big increase in the activity in the housing market. So just like the rest of the economy was doing, Ohio felt the brunt very deeply and is beginning to recover just like the other parts of the economy. But again, right, we have to get to that point where people are vaccinated until we really see. So this is a different kind of recession and recovery because it's really driven by the virus. The virus is the key thing. And of course, the vaccination against the virus, that's really going to matter in terms of the economic outlook.
So your purview is both national and then regional, and obviously you're covering a number of states here in the region. I don't know to what extent. I don't know if there's anything really you look at different in Ohio versus the rest of the region. But what do you look at when you're watching the regional economy go through the various phases of the pandemic?
Right. Yeah. So one of the things that I started out with is we really mobilized our contacts with businesses, community development organizations, to really understand where this pandemic was hitting hard. And it's different communities have different experiences with it, but generally, right, it really was hitting disproportionately small businesses, and the smallest of the small businesses. It was hitting communities of color, minority communities. It was hitting areas of low income areas. Women are disproportionately affected because, of course, women bear the brunt of a lot of the, schooling, the fact that schools were closed and childcare was closed. And you see it in the number of women who have left the workforce, right? So they're not counted as part of the workforce anymore because they're spending their time with their children or they can't work the same hours. So that was one thing that the governor, I know, was very attuned to that early on to understand about schools and the importance of schools and how the economy would fare afterwards. Ohio has more dependency on manufacturing than other parts of the country. In that sense, that was actually a good thing in terms of the recovery because the good side of the economy, the manufacturing side of the economy, is actually doing better than some of the service side of the economy. But again, I would say overall, we're not doing much better or much worse than other parts of the economy in this. This is really what's different about this kind of event than what you'd see if in a hurricane or other kind of natural disaster is this was really global. It really hit not only all over the United States, but all over the world. And that's very, very significantly different than the past recessions that might have started in a financial sector or elsewhere. And so when you think about this, you have to think about this a little bit differently. And that also means that, how the economy will recover, there's a lot of uncertainty around that as well. And so that's something to keep in mind, is that we haven't really lived through something like this before. That's really a global downward shock to every activity. And we'll have to see how it picks back up. But that's, I think, why it was important that we had the support from both monetary policy and fiscal policy as then the economy could get back on its feet and try to recover as we go.
Yep. Okay, thank you. The pandemic recovery included, but also beyond that, what do you see as the keys to the region's economy long term?
Yeah, so there's a lot of research that really points to the things that are really important for economies that do well in terms of being resilient to downturns and being able to pick themselves up. So one of them is population growth. You need to have a growing population in order to support jobs and businesses going forward. So on that score, I know you're losing population in Toledo, and Ohio is, basically gaining, but only a little bit. That would be one thing, that areas that do well are gaining population. The other thing, of course, is education. Education is a key. So if you have, fewer people, but they're much better skilled people, you can do very well. And that's also something that, I know you have very good educational institutions in Toledo. That's something that's very important to make sure that that's supported and you get people educated and your students educated so that they can actually handle what's coming in terms of technological change. And that's going to continue. There's going to be a lot of technological change and people need to skill up. The Cleveland Fed has done a lot of work actually with the Philadelphia Fed, as you pointed out, I came from Philly, on what we call opportunity occupations. And these are occupations that pay well, but don't necessarily need a bachelor's degree. And there's a tool on our website that actually helps people sort of understand what's the path to getting to those jobs, like what kind of educational services do they need. So I would welcome people to look at that if they're either looking for people to hire or also knowing people who are kind of looking for that kind of employment. So there's a lot of avenues to hire skill sets. And I think that's the thing that people need to keep in mind, is that we really need to educate ourselves. The US relative to foreign countries, we're falling behind. We're not as educated as we used to be on top. Now we're not. There's other countries that are becoming better educated than we are. And I think that's an area that we should all focus to make sure that people have access to quality education at all levels, from preschool on up, so that we're actually going to be able to maintain our standards of living going forward.
And federal help has changed even in the last week to 10 days since we sent out this question, so I'll modify this one a little bit. There is more federal stimulus support coming from Congress. What do you think we need, and how does this alter the Fed's view on accommodative monetary policy?
Yeah, so that's a really good question. So, Congress and the administration will deal with sort of what the particulars are, but there's no doubt that more investment in vaccines, production, distribution could bring a closer end to this pre-vaccination phase that we're in and get us to that post-vaccination stage. And that's important because the sooner we get to that point, the stronger the foundation for the recovery will be. So the longer that goes on, right, we will see more weakness in the economy, and that will make it even harder to grow out of that. So I think that's an important part. It's also should be recognized that while a lot of people have, been helped and they have their jobs back, there's still a lot of parts of the economy that aren't. And, aid for people who are unemployed still, who may be underemployed. So not only are it's not only the people who are getting unemployment insurance now, but there are a lot of people who are working, but working much less. There are certain areas of the country that need it more than others because they're low and moderate income. So that kind of aid really, it's not really stimulus, because it's not about stimulating. It's really to get them to the point where we're post-vaccination recovery that needs to be done. And I think those are important things. And then aid to schools and aids to the local and state governments, I think also could be helpful, because of course, a lot of the distribution of the vaccines is being done through the state and local governments. And so they need to make sure that they have the right personnel in place to be able to speed that up. Because again, this is all really about getting over this hump that we're in and getting to the point where everyone's vaccinated and we can kind of get back to a more normal economic recovery.
Yep. One of the things that the Fed certainly deals with is income inequality, and certainly probably other than next to the pandemic, the other big issue sort of last year, although this has been going on for hundreds of years here, is racial inequality in the United States. What is the Fed's take on that, and what do you see happening in the future?
Yeah, so I think this is a very important issue, and it's a very important point in time. And I hope it's not just a point in time, but a path forward to really understand the disparities that are seen. And these are long-lived disparities, as you point out. This is not something that happened overnight. The pandemic illuminated some of those disparities, but it didn't really cause the disparities. Those are long-standing disparities that were passed down generation after generation after generation. The Cleveland Fed has a program on economic inclusion and economic opportunity, and we're doing a lot to try to illuminate some of the issues and come up with policy solutions that could actually, affect change. It's not really in the Fed. We don't have the tools to really target some of the things that need to be done, but there are things that even we can do with our policy tools. For example, we're now undertaking a modernization of the Community Reinvestment Act, which is, of course, a law that was passed in the 70s to try to make sure that everyone had equal and fair access to credit and that banks were serving their low and moderate income communities. And that the revisions that we're making to the rules to implement those, which are out for public comment now, that's one path to making sure that, right, we're making sure that everyone, low and moderate income, minority communities and individuals have access to credit, because as you know, that access to credit is incredibly important to actually being able to engage in the economy. In terms of the Fed's dual mandate goals, even there, the way I like to think about it is, if we are leaving a lot of part of the economy behind, a lot of people behind, if we're not letting them be partakers of the economy and contribute to it, we're never going to have a strong economy, because we're leaving aside a lot of the people that can contribute to making us a stronger economy. And so, we need to be inclusive as an economy, because we won't be able to live up to our potential if we're not including all those people in, and so that they can take advantage of and contribute to our economy. So to my own mind, economic inclusion, access to economic opportunity is really important for the overall economy. And I'm glad that we're in the Fed are engaging with community leaders to really come up with some policy solutions that people should focus on. My own view is that one of those has to be education. I think education is a very, it can be a transforming factor in people's lives, individuals' lives, but it also, and there's research to support this, the more educated your community, the better off the community is. And so I think that's one of the avenues that we should be pursuing as a country, is to make sure that people have access to education and they can perform well once they have their degrees and be engaged in our economy.
I think that makes sense. It's certainly very good things to focus on as well. So there are questions that came in earlier about whether it will be easier or harder to adjust monetary policy and the related issues, sort of pulleys and levers that you use with the new administration in Washington. What's your assessment of the new team?
So, I mean, since there's always a good working relationship between the Fed and the Treasury. Now, the Fed, in terms of our monetary policy, is independent from the government. So we've been given, the privilege of being able to set monetary policy, right, to achieve the goals that Congress gave us, but not, sort of separate from any political considerations. And that's good, because, we're setting policy to try to influence the economy over the medium to long run. So having it separate from these short run political considerations actually yields better outcomes and better economic outcomes. But that doesn't mean that we're totally separate from the Treasury in terms of, Chair Powell regularly speaks to the Treasury Secretary. And so early in the pandemic, of course, there was both fiscal and monetary policy addressed. It had the same goal, was to try to get the economy back on its feet after this, horrible, negative, unprecedented shock. And so it was working well in tandem. It wasn't coordinated necessarily, but it was certainly complementary. With Janet Yellen as Secretary of Treasury, of course, she knows the Fed quite well. She also knows the importance of maintaining that independence of the Federal Reserve. But I think that she and Chair Powell, her Treasury and Chair Powell's Fed will work very well together and continue to do all they can to get us and the economy back to more normal economic conditions and get us back to that strong economy we had before the pandemic hit.
That makes sense, and hopefully that's something that we all support. That they're going down the right path here. So I know questions are starting to come in, and we will open up questions from the floor. The first one actually, and maybe we were remiss in not thanking Troy Greeley from our club for setting this up in the first place. And he was the original connection and worked with you and DiTeodoro from your office who helped put this together. And Kevin, can we plug in Troy here for a question? Troy, we see you.
Am I unmuted?
Yes.
Oh, good. Thank you. Well, I just wanted to thank Ann as well. She was so helpful in setting this up. So thank you, Ann. And one of my questions is a little bit odd, and it might not be in your lane, but helping individual investors is what I do. And there's been comments that it's so tough for retired older people that used to always buy CDs, and that would sustain their income in retirement. When do you think we'll get back to that time where we can actually buy CDs again and get a normal rate from them? And I guess the second question too, this is a lot. So many clients have said they're retired and they're surprised they get a stimulus check, or their grandkids are students and they're getting a stimulus check and they don't even need it. So have we gone too far on that side with doling out too many stimulus checks to people that maybe they don't need it? And thank you for coming and speaking today. I really appreciate it so much.
So thanks for those questions. You know, with monetary policy, the way it works for the economy is to really ease financial conditions. And that means lower interest rates, which we have at the moment. And you're right, when you do that, there are going to be distributional effects. You know, it's going to affect borrowers separately than savers on the opposite side. But, you know, in the medium to long run, right, it means for a stronger economy going forward. And so that's kind of the rationale behind it, is that we really need to ease those financial conditions now so that we can get back as quickly as possible to a strong economy and maximum employment and price stability. And so that's the rationale for that. But I think it's fair to acknowledge that, you know, in doing that, there are going to be some people who are, you know, the savers are not going to fare as well as the borrowers. But in the end, it's the right policy in order to kind of get the whole economy back to where it was pre-pandemic. In terms of the particulars on the stimulus or the economic impact statements, if you will. So there's always a trade-off that policymakers have to do. You know, you could do a very targeted package that really was trying to really make sure that you hit particular people who really needed the money. All right, that takes a lot of time. Or you could be less targeted and broader stroke so that you don't miss people who really need it. That can be done much more quickly. And I think, you know, that's something that a policymaker, a fiscal policymaker always has to have in mind, is that, you know, if you want to do very targeted things to make sure you don't have anyone getting a payment that shouldn't get it, right, that's going to take you much longer than if you say, okay, we're going to be reasonable about this as much as we can, focus it on people who need it, but be broader because we don't want to miss people who actually need the help that we may not be counting in our numbers, right? And that can be done quicker. And I think that's the kind of calculation that had to have been made by Congress and the administration. And so, you know, there is a good argument for quicker because, you know, you don't want this to linger on longer than it has to, because that actually weakens the economy. It's almost like, where are you starting off from once we get to that post-vaccination recovery? And you want to start out as strong as you can, given the circumstances. So quicker probably would have been where I would have come out with. But, you know, I take the point that that means that probably there are going to be some individuals who may get stimulus or economic impact statements that may not have needed them at the time.
Thank you. Next question is going to be from past President Sharon Skilleter, and Dr. Mester, as part of this question, which is similar to a couple that came in prior, will be concerns about inflation. Past President Sharon.
Yes, thank you for joining us today. My question was, how does the trillions of dollars of federal stimulus put into the economy affect the long-term position of the Federal Reserve?
So that's an excellent question. So again, we're easing financial conditions. We're buying those treasury securities and mortgage-backed securities, and we're leaving interest rates at zero for quite a time, but we're guided by, right, our dual mandate goals of price stability and maximum employment. And, you know, once we get to a point where we've seen substantial progress on those, we see inflation hitting 2% and on a trajectory to rise above 2% for some time, right? Then that's the point at where we'll reconsider the accommodation that's in the economy. But there's good reasons to think that really it's going to take some time to get inflation back up to 2%. I do think we'll see some higher inflation, measured inflation numbers in the next couple of months, for the simple reason that some of those really low inflation rates that we saw, or low levels of prices that we saw when the pandemic first hit, are going to go out of the numbers. So just as a mathematical construct, you're going to see some increases in inflation rates, and you're going to see some higher prices in some commodity prices, for example, where there are shortages. But that's different than saying the underlying level of inflation is 2 and on its way above 2 for a little bit. So I think that'll take some time. If it takes shorter than we think, that's okay, because we know how to control inflation on the upside. The challenge over the past decade has been inflation being lower than we want, not higher than we want. So again, our degree of accommodation is appropriate given how far we are from those dual mandate goals. But as we make continued progress towards them, then we will reconsider the accommodation, but that probably won't be for some time.
Thank you. Next question from Dr. Doug Neckers. And folks, when we join, just because there's several questions waiting, can you limit the questions to one? Doug, go ahead.
Thank you very much for your conversation today. Excuse me, I'm a scientist, and so I have to mention that I think that Congresswoman Marcy Kaptur has recently introduced the idea of an Institute for Viral Diseases at NIH. I happen to think, and some of my colleagues do as well, that we were terribly unprepared for this virus, and knocking it out so quickly and getting the economy back in place is not going to be as quick as we think it might be. What are your comments, excuse me, on the scientific community's contribution, and how does the Fed figure in research and development as part of the equation that's going to protect us from future viruses?
So I, agree that, this is all, the virus is really controlling the economy here. And the progress that's made on the vaccinations and the distribution is going to be the key thing that really gets us back to an economy that, we had pre-pandemic, and that may take a while. I mean, the initial rollout of the vaccination has been not as quick as many of us hoped. There are new strains of the virus that are out there. Not as clear the data on the vaccinations, how well they'll work. So it's all being driven by the investments that we make in science, the investments that are made in R&D. And to my mind, the government has a real role in supporting, right, that kind of investment, right? And that kind of investment that basic science, right, is something that's a public good. And so I think there's a strong argument that those investments, right, we need to do better as a country investing in that kind of basic R&D, basic science, right, so that we are better prepared for what comes in the future. So, I would support that as an investment that would make us better off when the next thing comes along, whatever that may be.
Thank you. Next question is from John Wasserman.
My question is, what is the long-term outlook for Social Security Medicare and Medicaid, in your opinion? There were solvency issues even before the COVID, and I'm wondering what your take and outlook and thoughts are on that.
So as a general proposition, I do believe that the country is going to have to reevaluate those kind of programs going forward, given the numbers that come out of the CBO and other, agencies that really talk about the cost of those programs. And there's ways of doing it. The Social Security is less hard to deal with than it is the Medicare spending, right? Because we need to get the fiscal house in order in terms of a sustainable path for that. I mean, I guess I'm hopeful that we'll be able to make progress on that. What I don't want to leave you the impression with is I think that's something we should deal with now. We're in the middle of this crisis now. And I think the first order of business is really to get to the point where the economy is back to some semblance of normal. So, the government is debating now about spending to try to, make sure that we can get through. And I'm supportive of that. I think both fiscal and monetary policy is needed, right, in order to get through this pandemic period to the post-vaccination period and kind of get the economy back on track. But, right, that's not to say that, we don't have an issue out there in terms of putting fiscal spending on a sustainable path. And that's going to mean that we're going to have to really look at those programs, the Medicare programs, Social Security and other programs, defense spending, et cetera, and really take a hard look at those.
Hang on, I think I was muted there. Next question is from past President Chuck Stockton.
There you go. Yes, I have a question regarding the suggestion that some sort of national service would be a good idea for a lot of these young people who don't have the skills, but could benefit greatly by having a national requirement of some national service working on infrastructure or whatever, those kinds of projects, and gain the experience that would help them as they move into the private sector. And also it might be a very good way for them to deal with, in exchange for that national service, cancellation of student debts, student obligations that they have accrued, and thus also be a stimulus to the economy. What's your thought about that?
So that's an idea that's out there. I think the basic idea is, how do we get people to develop the skills they need for the modern economy? And that's certainly an issue or a program that we should look into as one way to do that. I agree totally that education is a key to not only helping individuals, but helping communities. And so things that can actually make it more affordable to go to college, that can also make it more likely that people actually get through college, right? We see a lot of people who start college, but either don't have the financial wherewithal to get through or weren't prepared enough, right, to be able to get through college. And so, routinely in our surveys, when we ask, why didn't you finish your degree? You'll hear from people who say either they didn't have the funding to get through or that they didn't have the grades to get through. And that's adequate preparation beforehand. But certainly programs, it's similar to like apprentice programs that businesses offer. Those can be very important to having students develop their skill sets for jobs in the future. So I think that's certainly something we should be looking into as a way of making sure that people have opportunity.
Thank you. Dr. Mester, you look at more economic factors than most of us probably even know about, let alone can actually follow. But as is the case in most businesses, there's a smaller group you focus on. What as you look at you and your Fed colleagues look at the broader economy and the stock market, what are just a couple of the key factors that you pay the most attention to?
Yeah, so it's interesting. In this episode, we've all been starting, really having to understand medical statistics, which we never had to do before, caseloads and positivity rates and those kind of things, which were, we never had to look at those before. So we're looking at those very carefully to sort of understand the viruses. We also innovated in a way. We're doing a national consumer survey of COVID and the consumer at the Cleveland Fed. And that's been incredibly useful. It really tells us about people's attitudes to engaging in the economy. You could see when the caseloads were going up, people, and it's a daily survey, so we got very, very good information. People were reporting that they had disengaged, that they weren't going out, that they didn't plan to go out to restaurants. You could just track it with the number of cases and see that in the data. So those are things that we weren't looking at before that we're looking at now. And then, of course, what we like to look at are things that are related to our dual mandate goals. So, for example, labor force participation rates. And now, because we understand that they vary quite a bit by location, by ethnicity, by race, by income levels, we're looking at very disaggregated data on that. By gender, that's where we understand sort of the fact that, again, the pandemic is disproportionately harming women and their ability to stay in the workforce. So things related to our dual mandate goals are very important to us. On the inflation side, of course, we're looking at measured inflation rates, but as you may know, the Cleveland Fed has an inflation research center, and we produce our own statistics on inflation, median run inflation, and to try to get a sense on what those inflation trends are. So I like to look at a lot of different statistics because I think it gives you a real better picture of what's going on. But I have to point out again, it's the anecdotal information that we get from our advisory councils and our business contacts like you that really give us much more context about what's happening and where the path is going. So the data tends to be lagged, a lot of the official data, but what we get from you all is really telling us how you're coping with some of the pain out there and how you're dealing with the fact that, some of your employees, are much, getting ill, and then how do you deal with that? So that's been incredibly important in this episode.
Thank you. I noticed a hand raised from Kevin Mullins. So Kevin, you can unmute yourself.
All right, Bob, thank you very much. Dr. Mester, thank you so much for being here and for your presentation. You talked about the importance of education. I know there's a lot of conversation coming out of DC right now about whether it be $10,000 or $50,000 college loan forgiveness. What are your thoughts about that as a stimulus for the economy, as well as how that would impact educational attainment rates?
Yeah, I mean, that's one path you can go in. I think, you also, whenever you're doing that, you have to look at the people who paid off, right, their loans, and, whether it's going to have a differential impact on them. You have to also look at whether it's better off to offer a scholarship type program that allows people to sort of borrow, but in a way that it's forgiven or linked to what their income is post-college. I think that makes sense to me, right? You don't want to put people in such a dire position that they can't pay off their loan if they don't get a job after college. So there's a number of programs out there, and I don't want to, back one versus another, but I think the idea that we need to make education much more equitably available to people who may not have the means to actually go to get educated, I think that's very important. And that's going to matter for the future of the country as well, because I don't believe that the technological changes that we're seeing are going to abate, and having people have the skill sets that they need to actually engage in the modern economy is going to become increasingly important.
Thank you. One last question that was sent in ahead of time. There's been this combination of a couple questions, but there's been a lot of volatility in the market in the recent weeks. Two examples would be GameStop and silver. What does the Fed make of this? And do you see signs of increased financial instability?
So that's an excellent question. So as you know, and the Fed was very explicit about in our our new framework for how we do monetary policies, you need to have financial stability to have macroeconomic stability. So financial stability is a necessary condition. And we spend a lot of time making sure that the financial infrastructure, if you will, is a stable infrastructure. So for example, you know, we make sure that banks are well capitalized, that they're meeting their liquidity requirements. And as you know, that was really important. The fact that the banking industry was well capitalized going into the pandemic meant that we could rely on banks to be an important conduit of credit to households and businesses, which was an important source of support for the economy. So we're always monitoring for vulnerabilities. We're always looking for places where maybe the financial system isn't as resilient. Currently, right, you know, I don't think that that's a major impact to how we're doing policy. So for example, the volatility that you pointed to in terms of those particular, the silver market and the GameStop situation, there wasn't broader implications of that for the financial markets and financial conditions that would really suggest that it's unstable. But I did support Janet Yellen, Secretary Yellen, you know, bringing together the regulators to take a look at that. And because I think that's the important thing. We want the markets to be fair. We want them to be equitable. We want them to make sure that, you know, the game being played is a fair game. Because they're so important for the U.S. economy. So I supported that, but that doesn't really have an impact on how I'm thinking about monetary policy right now. I think, you know, we're basically in a pretty, you know, good financial conditions in terms of financial stability, and, you know, we're going to continue to monitor for excesses as we go forward.
Well, Dr. Mester, thank you. We're glad that you're a big part of the Fed. We're glad you're in Ohio, and we're certainly glad to have you here today at our Rotary lunch. So thanks for the program today. And President Alex, I will turn it back to you to wrap up here.
Thank you for joining us today, Dr. Mester, and for an exceptionally informative presentation. Also want to thank all our guests that have joined us today as well. And now, here's past President Chuck Man to start off laughing with Chuck's Chuckles.
One of the items on the list of strange things that happened during last night's super event was the hologram of the late Vince Lombardi floating around the stadium reciting Proverbs. While Lombardi certainly was a quote-worthy inspirational coach, I found that this NFL presentation was more about special effects and, well, was just sort of a little creepy. But here are a couple of non-holographic Vince Lombardi quotes. "We didn't lose the game, we just ran out of time. And if you aren't fired with enthusiasm, you will be fired with, if you aren't fired with enthusiasm, you will be fired with enthusiasm." Got myself confused on that one. A few other quotes from coaches. From John Ralston, the former Denver Broncos head coach: "I resigned as Broncos head coach because of illness and fatigue. The fans were sick and tired of me." Houston Oilers head coach Bill Peterson, two quotes from Bill Peterson: "You guys line up alphabetically by height. And men, I just want you to be thinking of one word all season, one word and one word only: Super Bowl." Football player Joe Theismann, ESPN announcer and former NFL quarterback: "Nobody in football should be called a genius. A genius is a guy like Norman Einstein." New Orleans Saints comes first. Hollywood Henderson, former Dallas Cowboys linebacker, commenting on Steelers quarterback Terry Bradshaw's intelligence: "He couldn't spell cat if you spot T." We're almost done. I have Michael Vick: "I have two weapons, my arms, my legs, and my brain." Dick Butkus: When I played pro football, I never sent out to hurt anyone deliberately, unless it was, important, like a league game or something. And finally, Art Donovan, I'm a light eater. As soon as it's light, I start to eat. President Alex.
Oh, Chuck, thank you. Thank you very much. We knew that Dr. Lester would be a hard act to follow, but you did a great job, Chuck. You know what? We have that video queued up. Why don't we show that video real quick as a reminder to send us your vaccine pics. Okay, there we go. Thank you, Kevin. So next Monday, February 15th, no meeting in recognition of President's Day. And our meetings today. So this morning, Youth Services had a meeting at 10:30, and we do have one meeting following this meeting, and that's the vocational services. So please stay on, and you will be directed to the breakout room. Again, thank you everybody for attending today. Thanks for the media. Thank you to our guests. We are adjourned.